simultaneously, amend them the way the committee wants to amend them, and pass them on to the next committee referral, which is a rules committee, and then onto the floor. And then the Senate could collectively do their floor process and modify the bills as the votes in support on the Senate floor warrant, and the bills or bill that has majority support moves on to the next body, and if neither one of them or both of them don't, that action takes place. But I think there's a lot of benefit in the public process to keep the two concepts fairly separate and clean, so the public can understand the flow and the discussion, and the elected officials can make a clear and concise, or make a clear and concise position that they want for their constituents. But we all need to understand the ramifications of both bills from all angles. Not only cash flow, tax consequences, public support, historical support, all that, and make an informed decision. So I personally support working on both these bills, taking them on and moving them collectively, and those that don't support a particular bill can amend it or vote against it on the floor.
Senator Hoffman. Chairman, can we have a brief at ease?
Brief at ease. We're back on the record. Any further discussion before the Ledge Finance comes up and walks us through a comprehensive slide deck today?
Mr. Chairman, this is Bill Wachowski.
Senator Willikowski.
Yeah, thank you. And I think everyone on the committee and in the legislature and the public certainly wants a resolution on this, but I think it's important to remember that even if we pass a statutory change, there's still no obligation by the legislature to pay this. You could do a 50-50, you could do a 75-25. Some future legislature, unless there's a constitutional amendment, could still decide not to appropriate that amount. I think that's important for us to all remember.
Yeah, thank you, Senator Willikowski, and I just want the public to know we haven't followed the Constitution yet on the capital budget. So there's that as well. Senator Stedman.
This is a brief comment. It's very clear that we've got a statutory formula for a dividend that we've had it's been difficult to attain that payout and keep the state on a stable fiscal ground the last several years. And that can be reflected in our savings position, which has been eroded by the billions and billions. But we have never, ever missed a dividend in the state, and it's never been constitutionally protected. We've never even come close. Well, we have once. There was a veto of a dividend that drove it to zero. But the legislature has never supported a zero dividend, and I don't see ever a possibility in the future that ever supported zero dividend. So, and I recognize the interest in the constitutional protection of the dividend, and that's a discussion that'll, take place. But I think we need to try to figure out what the structure is going to be of a dividend. So there are multiple steps through the process.
Senator Von Imhoff.
Thank you. So Senator Willikowski, you are correct in that as the appropriating body, we can appropriate the level of funding for any department and any program. However, I think creating a statute that is rational and sustainable over the long term so we can pay our bills and provide funding for all departments, I think will help us fiscally and, more important, just politically as we think about the state in all its capacity. I feel that at this table and on the floor, we've talked about the dividend calculation more than education, than public safety, than homelessness, drug and alcohol rehabilitation. Those are other things I'd like to talk about and help move the state forward. And I believe once we solve the dividend with a sustainable and rational calculation, we can follow the law and finally begin to address with our full hearts and energy other challenges that the state is facing. Thank you.
I believe at this time we'd like to have legislative finance come up. Mr. Painter and Mr. Bell. You gentlemen could come up and put yourselves on the record. And I think there's a nice presentation here today that people will enjoy.
For the record, Alexi Painter, Legislative Finance Division.
For the record, Connor Bell, Fiscal Analyst with Legislative Finance Division.
And Mr. Chairman, similar to our previous presentations, I will cover the first half with the review of the budgeting assumptions in these models, and then Mr. Bell will walk the committee through the models themselves. So first, we will review the Senate Finance Modeling Baseline. This was used by the committee for models that we produced on February 10th and replicated here. The one difference I'll get to on the next slide, but for the revenue assumptions, These models are based on the Department of Revenue's fall revenue forecast, which assumes $71 oil in FY23, and then follows the futures market thereafter, the futures market as of December when it was released. It uses the DNR oil production forecast, which projects that Alaska North Slope crude production will increase from about 500,000 barrels per day in FY23 to 586,000 barrels per day in FY31. And then for the permanent fund, we're using the Callan return assumptions, which is a 5.86% total return in the current fiscal year 22, and then 6.2% thereafter. On the spending side, the Senate Finance Modeling baseline for agency operations start with the governor's amended FY23 budget, so that's slightly different than the previous models where we use the governor's unamended budget, so there's a slight increase there, I think about 14.8 million. And then these models assume that it grows at 2.5% per year. In addition, there's an assumption that federal funds that are being used in place of general funds in the current budget are replaced with general funds when those federal funds expire. And I'll get into that in a little greater depth in the next slide. And as I said, these are slightly different than the models that we saw a week and a half ago because of the governor's amendments. For statewide items, these scenarios assume that all items are funded to their statutory level beyond FY23 and in FY23, in fact. So this includes school debt reimbursement, the REAA fund, community assistance, and oil and gas tax credits. For the capital budget, these scenarios start with a $250 million capital budget in FY23, and that increases by 2.5% per year. And then supplementals, these scenarios use an assumption of $50 million per year, just based on the average amount of supplemental appropriations minus lapsing funds over the past few years. So to get into
Senator Stedman.
Sure.
Yes, before we speed on to slide number 5, I assume that the oil tax credits that you're referring to is the accrued liability that's on the books of roughly 700 million or so. And that is to get that debt paid off. Is that correct?
Through the chair, Senator Stedman, yes, that's correct.
Please continue. No further questions. Please continue.
All right, slide 5 discusses that 2.5% growth rate in a little greater depth. So legislative finance, when we do modeling, we usually start with the inflation as our growth rate. Currently, the assumption is 2%, although it sounds like Callan is going to update that to 2.25%, and the Department of Revenue may adopt that for the spring forecast, so we may increase our assumption at that point. The Senate Finance Committee models use 2.5% growth instead, which is a little bit above inflation or above the inflation assumption. In comparison, the governor's 10-year plan does not grow the capital budget at all with inflation or any other number. It grows agency operations other than Medicaid by 1.5% per year, and then Medicaid specifically grows by 1% per year. Evergreen Economics, which is a consultant that the state has hired to look at Medicaid, said that absent policy changes, Medicaid would grow at 4.2% per year. So I guess the assumption is that the governor's 10-year plan is that they will make policy changes that would restrain the growth of Medicaid spending by 3.2% per year, which is a pretty significant assumption. By FY30, the difference between that 1%, or FY31, I think that should say, the difference between growing Medicaid by 1% or 4.2% is about $200 million per year in spending. So if it grows at 1%, the Medicaid budget would be about $700 million a year. By FY31, or it'd be $900 million with the Evergreen growth rate. So that one assumption is pretty significant for understanding the governor's 10-year plan, and maybe a factor in why the Senate Finance Committee chose to use a higher number than just inflation is to account for that Medicaid growth. And then I mentioned on the previous slide that there's several items that in the Senate Finance baseline change over time due to the expiration of federal funds. So there's several items in the governor's budget that are funded with short-term federal funds that are ongoing items that we'd expect to continue to be funded even after those federal funds are gone. And so in these models, we assume that when those federal funds expire, general funds replace them. And so there's 3 items here. There's the Department of Corrections DNA tracking program. That's an ongoing program that was started in FY22 and is funded with $1.1 million from the Coronavirus State and Local Fiscal Relief Fund, which would need to be replaced with general funds in fiscal year 24. The governor also funds the Alaska Marine Highway System with using federal funds from the infrastructure bill. That's a 5-year appropriation, and so the federal funds are expected to decrease after that. So these models assume that about $82 million of UGF is needed once those funds expire, starting in FY27. And that's kind of an approximation of the service level provided in the governor's budget, because the governor does not use those general funds. So it's sort of taking the current year's service level, the general funds in that, and then adjusting it upwards by the added service level that the governor is proposing in his budget. So we're estimating that would be about 82 million, but obviously in 5 years, it's kind of difficult to say where the Marine Highway would be in terms of fair support versus the general fund subsidy. And then also in the Department of Transportation, there's $24.3 million of items that are being funded with federal highway dollars and federal aviation dollars that are expected to be expended fully over the next 1 to 2 years. So those would need to be replaced in FY24. And I'd note that compared to our previous presentation, that number is slightly higher, and that's due to amendments in the governor's budget that increase the usage of those funds in the current year. So just to recap again this slide, these items are these last few items show up as increases in the general fund budget in the Senate finance models when these federal funds expire. So you'll see little upticks over time in the general fund budgets.
This is, for those listening at home, Senator Von Imhoff made a comment a few minutes ago, and if I misspeak, Senator Von Imhoff, jump in here, but FY30, we're showing the difference between 1% and 4.2%. Until we get this debate settled, one way or the other, then we can go to work on statutory changes in Medicaid to help constrain costs, maybe. That's one of the action items I believe that she might be speaking to. So there's other things to do in the building as it pertains to our operating budget where we can find more efficiencies. Thank you. Next.
So I was asked to update this slide. This is a slide we showed last year, just outlining some of the obligations and funding needs in the state. Some of these are funded in our ongoing budget, some are not, or are not fully funded. And these items total about $10.5 billion. The largest of these kind of ongoing obligations is the PERS and TERS unfunded liability. That number is now much smaller than it was a year ago. It's still about $4 billion. There are annual payments that we will make through FY39, and then the unfunded liability is expected to be paid off in FY39. In FY23, this is just shy of $130 million of unrestricted general funds in the budget, in addition to the amount that the state pays as an employer, which is just as part of the agency operations budget, so it's a little hard to separate that out. But really, the ongoing cost is even higher when you add that in as well. The state has $1.2 billion of general obligation bonds outstanding, as well as other state-supported debt. And currently that schedule is expected to run through FY41, although there may be refinancing that extends it beyond that. And in the governor's current budget, repaying these debts will cost $92.4 million. There's also municipal school debt service through the school debt reimbursement program. There's just shy of $700 million outstanding of municipal debt. For school districts, the state has a statutory responsibility to pay a portion of those. And Those payments are currently expected to go through FY39, although there's a moratorium on new school debt that will expire in 2025. After that, there may be new debt added that would increase that amount in the future. So this is not kind of an ended liability. When the moratorium ends, we could see more school debt. And in the governor's current budget, there is $63.9 million of UGF plus $15 million of designated general funds going for that purpose. Oil and gas tax credits, as Senator Stedman mentioned, are actually down to $565 million is the estimate for the outstanding tax credit payments. And the governor's budget includes $199 million for that purpose. Based on the fall forecast, these would be paid off in the next, I think, 3 or 4 years. If the spring forecast shows higher revenue, we may see those get paid off even faster if we increase the deposits. There's a deferred maintenance backlog, including the University of Alaska, of state agencies of about $2 billion. We're making annual appropriations through the Capital Income Fund for deferred maintenance. The governor's budget has $25.2 million from that fund source. There's also additional projects that the governor is proposing to fund through the general obligation bond proposal that are deferred maintenance projects as well, but there is not really an ongoing source for more than that, and as well as just the normal maintenance and operations that are paid through the operating budget. School districts in both the unorganized and organized areas can put projects on the school major maintenance list. There's also a school construction list for only the unorganized areas. Those lists have $389 million of projects on them. However, that's not really an exhaustive list of the projects that may be out there. That's only the projects that districts have asked to be put on the list. There may be hundreds of millions more or even billions more of outstanding major maintenance and construction needs that school districts have that are just not on the list. So that number is really kind of the lowest estimate. The likely number is significantly higher. And the REAA fund can be used for some of these projects, and that has a $34 million deposit this year, not for all of them. And there's no real designated funding source for the organized areas that have projects on the school major maintenance list. In the past, that's been done through legislative appropriations. There was an appropriation included in the legislature's budget last year that was vetoed by the governor to go down those lists. Finally, there are rural Alaska sanitation funding needs that are met through the Village Safe Water Program. DEC's current list estimates $1.8 billion outstanding need. In the governor's budget, there's $19.5 million of state funds and $72 million total, including federal funds for that purpose. The infrastructure bill is expected to direct substantial additional federal funds to the tribal portion of this that will address a portion of this need, but not necessarily all of the projects on this list.
Senator Von Imhoff.
Thank you. So, Mr. Painter, the PERS and TERS unfunded liability, you have the payment is $129 million. Can you elaborate on that? Does that include the pension as well as the healthcare portion, or just the pension portion?
Through the chair, Senator Von Imhoff. So the ARM board chose to set for PERS the payment, the past service liability for the healthcare portion to zero for this year. So that payment does not include a payment into the healthcare fund because that's fully funded. That's just on the pension side that shows the unfunded liability. So that $4 billion unfunded liabilities number is all on the pension side, since there's no unfunded liability currently on the healthcare side.
Follow up?
Follow up.
Thank you. So, but that could change on a dime, figuratively and literally. And so in the back of our minds, we should just probably think that this $129 million probably could double if the healthcare portion dipped below 100% and went somewhere in the 90s or even as low as the 80s funded. Is that correct?
Senator Von Imhoff, through the chair. Yeah, these numbers could change year by year. They're currently doing an experience study to look at costs and compare that to their projections. That could change the costs, as well as, of course, investment performance. Either of those could definitely change the costs significantly.
Thank you.
Senator Wilson.
Thank you, Mr. Chair. Mr. Painter, on the last item for the rural Alaska sanitation funding need, I thought that the program said that with the new infrastructure bill that the IHS would get the over $2 billion for Alaska. And I understand that probably won't do all the, sort of ongoing maintenance needs for those services, but definitely would be a huge reduction in turn to the state's budget number.
Senator Wilson, through the chair, yes, that the infrastructure bill is going to direct substantial additional funds towards that need, which may bring that number down quite a bit. I think it's yet to be seen exactly how easy it is to get service to all these communities, but for sure, that will drastically increase the amount of resources going to this without any additional state match needed.
Please continue.
Okay, so Ms. Shine already summarized these two bills, but just to recap before we go into the models. So Senate Bill 199 is the bill that amends the PFD formula to pay kind of a stair-step dividend over the first few years, $1,100, then $1,200, and $1,300 growing with inflation, with a trigger mechanism so that if the legislature enacts revenue measures of at least $700 million per year, the formula will change to 50% of the percent of market value draw. And so the numbers on the bottom of the slide show what those PFDs per person would be estimated to be under both scenarios. So the top, you can see if the trigger succeeds, the dividend would jump up in FY26 when the formula goes to 50% of market value. Under the trigger fails scenario, in which the revenue is not adopted, the PFD would remain in the $1,300 range and then growing with inflation.
Senator Von Imhoff and then Senator Hoffman.
Thank you. So, Mr. Painter, I also think if you do appear in front of this committee again with a slide similar to this with showing the dividend amounts, does it make sense to perhaps show the hundreds of millions of dollars that correspond with those dividends also, just so we can understand the magnitude of what those payments cost the state?
Through the chair, Senator Von Imhoff, yes, we can include that in future versions of this.
Thank you. And just follow up?
Follow up?
I just think it's important when we start looking at 700 million of new revenue, there are 720-ish thousand people in the state of Alaska, but less than half of those are working and earning taxable income. And I think to try to get 700 million, hopefully that, I can't imagine that conversation, but 700 million in a state on the size of Alaska is difficult to generate in any type of personal taxes. It would be quite a bit of money. Thank you.
Senator Hoffman?
Thank you, Mr. Chairman. I wasn't going to comment upon that, but I don't believe that we would be, the legislature would be looking just at individual taxpayers. There are other entities out there. I know Senator Wilkowski has mentioned this on numerous occasions, and the per barrel tax credit and other revenue sources from the industry could also be utilized and may be considered. So that being said, under FY25, the $1,300 dividend, how much of a price tag is that?
Through the chair, Senator Hoffman. So on the subsequent slide where we actually model these, we have both the cost to the state as well as the amount per person. So if I could defer that to when we get to that slide.
Thank you, Mr. Chairman.
Thank you. All right, please continue.
All right, Mr. Chairman, next summarizing the provisions of Senate Bill 200. This amends the PFD formula to pay 25% of the percent of market value draw in FY23 and beyond. That would be about $1,250 per person in FY23. And just to note, this PFD split matches the version of Senate Bill 26 that passed the Senate in March of 2017. So we're kind of full circle to what this body passed 5 years ago. And again, the cost of this to the state will be on the subsequent slides that actually model that. But they would be, we'd estimate $1,243 in FY23 and then growing a bit faster than inflation as the POMV draw grows over the next few years.
Thank you. Next slide.
Mr. Chairman, in the modeling slides, we performed two types of stress tests. The first is a budget stress test, which instead of growing at 2.5%, assume that agency operations and the capital budget grow at 3.5% per year. The second stress test is a revenue stress test, which uses probabilistic modeling to simulate a range of possible oil prices and investment returns. And then for each of these PFD scenarios, we'll show the non-stress model output and then the two stress tests sequentially.
Thank you.
Okay, and I will turn it over to Mr. Bell to explain sort of how these stress tests for revenue will work and then to walk through the models.
Mr. Bell.
For the record, Connor Bell, Legislative Finance. We've showed this slide to the committee before, but just to run through it again, this is an example of one of the cases in our stress test. What we do is we run 2,000 different trials for a given scenario. And we basically draw random oil prices and permanent fund returns and oil production. Oil production out of those is the least significant contributor to the variation, basically within the bounds that we're using. So we basically are taking a bell curve of a range of permanent fund returns. The average is 6.2% in any given year, and the standard deviation is 13%, meaning 68% of the cases are within 13% of that 6.2, so within a range of -7% and 19%. Annual returns of the permanent fund, that's where you'll see 68% of the cases, if you're thinking about it in terms of a bell curve. And the oil price is using the Department of Revenue's fall forecast, and this is basically showing just one of those 2,000 cases. It's at the 25th percentile level, meaning that in terms of total deficits over the entire 10-year period, 25% of cases saw more deficits than these assumptions, and 75% fared better in terms of deficits. And this is just kind of showing you what a typical case looks like. It's not, the overall average price is $58. It's below the, mid to high 60s you see in the DNR forecast, but it's not too far out of those bounds. And the permanent fund return is 5.4%, but really what you're seeing is that this variation can be pretty harmful, especially on the left you see the average oil price by year. It starts out in the high 60s, low 70s, then it drops to the 40s, spikes again, and then it has some variation for the last several years. And so while it averages out to $58, there's a lot of variation. The permanent fund total return is on the right, and you see a couple negative years early on, and generally the first several years are lackluster with stronger returns on the out years. And that has a pretty negative effect since the earnings reserve balance is, we're still inflation proofing from that fund and drawing for the POMV draw. And so if earnings are negative for multiple years in a row, that can be pretty hard on the permanent fund balance. And what Callan has said in their analysis is that it's not just one really bad year that is really harmful to the permanent fund or the earnings reserve. It's multiple years of slow or no growth.
Next slide.
All right, this is back to a deterministic forecast, meaning we're just taking a single set of assumptions. We're using the Department of Revenue's fall forecast in the permanent fund, Callan's forecast for the permanent fund returns. The chart on the left is showing the surplus, basically the different components of the budget compared to revenues. The blue bars are traditional revenue, such as our oil production tax or corporate income tax. The green bars are the percent of market value draw. That's the money that we take in a structured draw from the earnings reserve account from the permanent fund to pay for government services. The yellow bar, which you only see in FY22, is our draw from statutory budget reserve or constitutional budget reserve those are our savings accounts. And that brown bar is the ARPA revenue replacement, which is federal COVID-related funds. And the dotted line on that left bar, on the left chart, is showing our budget before incorporating a PFD, and the solid black line is the budget after accounting for the PFD. And so we're running $300 to $400 million surpluses every year under the scenario of paying a 25% of POMV PFD, which is what is outlined in SB 200. The chart on the right shows the budget reserve ending balances. The yellow bars are the constitutional budget reserve and statutory budget reserve, and the green bars are the realized earnings reserve account in the permanent fund, which is the part of the permanent fund that we can actually constitutionally use for government services. And at the bottom, we show the effective POMV draw rate. The POMV draw is based on taking the average, the fund balance of the permanent fund for 5 of the 6 preceding fiscal years. And so if we are using the statutory draw, it's at 5%. This does not mean we're taking actually 5% of the fund in a given year. And so basically you'll see that number exceed 5% if we're overdrawing from the permanent fund and going beyond that structured draw calculation. And then at the bottom, you can see the cost of the dividend of this 25% PFD dividend and that amount per person. And so it varies from about 800 to 11 or 1200, or 800 million to, in the out years, $1.1 billion.
Senator Hoffman, do you have a question, sir?
Yes. What are, on the row you have the surplus row from FY '22 of $279 million growing to FY '31 to $413 million. But more importantly, I think the figure that the public would be interested in is the chart to the right, which has the budget reserve funds from FY '22 going approximately $16 billion up to just under $25 billion. So is that correct? It would grow about $9 billion under this scenario?
Through the chair, Senator Hoffman, yes, that's correct. And much of that is due to the, basically, any surplus at the end of the year will, under the Constitution, go into the constitutional budget reserve. And so those surpluses get put into the constitutional budget reserve as savings. And that's why you're seeing the increase in the yellow bars. And yeah, it leads to a bigger cushion of budget reserves by the end of the period.
Thank you, Mr. Chairman.
Senator Von Imhoff?
Thank you. Of course, that requires discipline from the legislature to not overspend in high years on pet projects. Thank you.
Senator Hoffman?
The legislature will do what the legislature does.
Okay, Mr. Bell and Mr. Painter, I think for future, when we come back, for those that are following along at home, if we could highlight that upper right-hand box that shows our multipliers, that would be good. I think it could pop out so people could see the changes between slides. Thank you.
All right, thanks, Mr. Chairman. Moving on, this is showing the same PFD, which is the 25% of the POMV draw going to the PFD, except now we're showing the budget stress test where agency operations and the capital budget grow at 3.5% instead of 2.5%. And the charts are all the same, but you see initially the surpluses are the same, but you start to see basically the surplus is going to zero by the end of the period as the budget outpaces the prior version. We don't see any ERA overdraws at this point. The PFD amounts are the same. So you're just seeing slightly less money going into that constitutional budget reserve. So the budget reserve chart on the right is basically growing at a slower rate.
Senator Von Imhoff.
So by fiscal year 30 and fiscal year 31, under this scenario, we would be running obviously just slight deficits. So I think what's important is during the years where we have a surplus, even if it's just a few hundred million, to set those aside in the CBR and SBR like you have here in the scenario, so we can utilize those funds in years where the market does potentially take a downturn. This is just a good illustration of the importance of setting some money aside when we can for those lean years. Because if you look in the last 25 years, I'd say probably 15 out of those 25 years we've taken money from the CBR to help balance the budget versus put it back in.
Thank you for those comments. And just remember, people, this is just a base budget. This doesn't account for the liability of the deferred maintenance that we have in all these categories that was outlined on about page 4. So please continue.
All right, moving on, this is the last slide for the 25% of POMV to PFD, matching Senate Bill 200. This is showing the revenue stress test, so it's the probabilistic modeling where we're running those 2,000 scenarios. At the top, you see the surplus and deficit amounts by year, which are similar to, but not identical to what you saw 2 slides ago. The chart on the left is showing the surplus and deficit amounts and how they vary. The blue bars are the same as those amounts at the top, which are the median surplus and deficit amounts. And then we're looking at this range of outcomes around that median expected outcome. So the green bars represent the 25th and 75th percentile, meaning that we expect 50% of cases to be, 50% of our trials that we ran were within those green bars, and 50% of trials were outside of those 2 green bars. And those are, showing surpluses, or at the 75th percentile level, surpluses of over $1 billion, and at the lower level, deficits of from 0 to about $500 million a year. On the right, that chart is showing the realized ERA balance, which is again the part of the permanent fund that we can constitutionally spend. The blue line is the median balance of the realized ERA. The reason why it increases in the first couple of years is because we're assuming no inflation proofing for the first few years because of statutory intent behind the earlier large inflation proofing transfer made by the legislature. And so that inflation proofing starts in FY25. And you can see at the 10% level, which means that 10% of cases fare more poorly than this. And the realized ERA balance goes to 0 by fiscal year 29. And at the higher end, you can see in significantly increasing balances from the permanent fund earnings reserve to $30 billion and higher. And at the bottom of the chart, we're showing the probability of a given CBR balance. So in any given year, what's the likelihood that the constitutional budget reserve has less than a given balance? And the first row is $2.5 billion, which was recommended by the committee as a target minimum balance to use the constitutional budget reserve as a savings account to use as a budget reserve. And so you can see the likelihood of it's somewhere around a 50-50 in the earlier years and becomes about a 20% chance that the CBR is below $2.5 billion. So again, assuming that budgets are constant and the legislature doesn't, basically that behavior and budgets don't change based on surpluses or deficits, we're expecting about a 20% chance of being below that 2.5 billion by the end of the period. And then the 500 million CBR balance, that represents the minimum recommended amount to have in the CBR just for short-term cash flow purposes, in contrast to using it as an actual budget reserve. And you can see a much lower likelihood in these cases of seeing below that $500 million balance.
Next slide.
All right, moving on to SB 199, which is, again, paying the permanent fund of $1,100 in FY '23, $1,200 per person FY '24, $1,300 per person FY '25, and then if the revenue trigger succeeds, switching to a 50% of the permit POMV draw going to the dividend. And in this scenario, we are assuming that the trigger succeeds. So beginning in FY '26, we are including $700 million of additional revenue in this scenario. And in the chart on the left, you can see those orange bars beginning in FY '26, and that's that new revenue we're assuming.
Senator Wilson? Pardon me?
If he's finished with the slide, I don't want to interrupt.
Go ahead and ask your question.
Yeah, thank you, Mr. Chair. My question has to do, I guess, with Section 13 of the bill, then with the new revenue. What happens if we hit that revenue sooner? Will this then slide over? Let's say if we hit that in year 3, year 4 of the 700?
Through the chair, Senator Wilson, I can't speak with certainty, but my understanding of the bill is even if the new revenue is instituted earlier, the 50/50 PFD would still only begin in FY '26.
Okay.
It wouldn't begin, the 50/50 PFD would not start any earlier.
Follow up?
Yes, and then also, I guess on the conditional effect language, we don't really have a definition of new revenue other than that the finance division director and the revenue commissioner has to agree jointly on what that new revenue is. And I just didn't know if oil prices, let's say, had a huge spike and it stayed at $100 a barrel. Would that be considered new revenue compared to the baseline or other items? I just didn't know if we can maybe get a better definition of new revenue in this, other than that new revenue does not include revenue from the permanent fund. So the ERA does not count as new revenue, which we all knew that, but I just didn't know if there's a better definition that we can get on the record for terms of new revenue.
Thank you. So noted, and we'll have that conversation when we bring the bill back up.
Mr. Chairman, for the record, Alexi Painter again. Senator Wilson through the chair, since I'm one of the two certifiers, I suppose, in this bill. It's written in that statute so that it's provisions generating new revenue. So existing oil taxes with no change to the tax but higher prices would not be a new provision generating $700 million of revenue. However, if the legislature changed the oil tax statute and then the revenue increased by $700 million in the oil taxes, that would constitute a provision generating $700 million. So, of course, that's why you kind of have to have a point of time. It may be that in 1 year we project that a given provision would generate $500 million and then another year $800 million because oil prices are volatile. That's the idea would be that on that date that that certification is made, it would be based on the current information, how much those provisions would change things. If that helps.
Senator Von Imhoff?
Thank you. So these models are very good, and you definitely have improved them just with the different modeling techniques and assumptions. But again, these are fiscal models. These are not economic models. And economic models is a whole different ballgame. And we look at the orange, which is new revenue here. It just shows money going from one area to another area without really being able to explore the economic impact of that. What is the new revenue? Where is it coming from? What are the consequences of that new revenue? I'm certainly not asking you to answer those. Those are just questions that I'm thinking about in my mind. So it's one thing for us to sit here in a vacuum and more of an academic exercise to talk about revenue coming from an unnamed source and being paid out in a 50/50 dividend? What are the consequences of that? How could that affect other parts of the state? Capital spending, investment from businesses into the state, people being able to find a job. Those are kind of things that are hard to quantify and hard to measure, but I think it's important to talk about. Thank you.
All right, please, did you have a follow-up, Senator Wilson? Please continue.
Great. Again, for the record, this is Connor Bell, Legislative Finance. And moving on to showing SB 199, again, with the trigger succeeding, so adding $700 million of new revenue, but also assuming the higher 3.5% annual growth in agency operations. And it is, just to follow up on what Senator Von Imhoff said, yet these changes don't take place in a void. There are effects of raising or lowering the PFD or instituting a new tax or any new revenue, and it's basically beyond our scope to be able to try to predict and model those. It's a really complicated exercise to try and get the magnitude of those effects. So we're not saying that those effects don't occur. It's just, ICER, the Institute of Social and Economic Research at the university, has done some of these estimates to try and get at a better understanding of what the impacts are of changes in taxation or PFD amounts and things like that. So back to this chart, we're showing the new revenues starting in FY26, and those yellow bars again are draws from our CBR, SBR budget reserves. You can see some draws in the out years as we start to run deficits later on. The PFD draws are about $2 billion once we go to the 50/50 PFD, compared to $900 million in the year before, so it adds about $1 billion, and so slightly more than the $700 million in new revenue in this case. So again, we're seeing, moderate deficits and increasing towards the end of the period as the PFDs get slightly larger, with the POMV draw growing.
Senator Wilson and Senator Von Imhoff.
Thank you, Mr. Chair. Mr. Bell, you mentioned ICER has commented upon some of these models and impacts. Do you know, do you remember any of the consequences, negative or positive, on an increase of the PFD or an increase on taxes?
Through the chair, Senator Wilson, I don't want to speak offhand. I can't remember it well enough to speak confidently for the record.
And Mr. Chair, I think there
Do you
was.
know the answer, Senator?
I thought it was a positive consequence of an increase to the general population of a PFD increase, and a negative for an increase of other statewide taxes.
If you got that handy, maybe you could share that with the committee. That'd be helpful. Thank you. Senator Von Imhoff.
Thank you. So this is an interesting budget stress test with a 3.5% growth. Of course, just to check right now, national inflation, and I don't know about Alaska inflation, but I think it's above 3.5. National inflation's about 5 or 6%. Is that what you're hearing right now, by chance?
Through the chair, Senator Von Imhoff, if you're looking at basically comparing calendar years, it is somewhere in that neighborhood. If you're looking at just year over year, comparing January to January, it's higher than that. It's about 7%. So it depends on what period exactly you're looking at.
So may I follow up?
Follow up.
So what we have here is, even at what we would call right now a modest growth at 3.5%, it begins pretty quickly to show its effects in fiscal year 27, definitely in fiscal year 28, where the growth of the budget, just potentially with inflation, outstrips the potential of new revenue. Not to say that we can't go above 700 million if we so choose, but again, there's economic consequences of that. The point that I'm trying to make is trying to keep costs down and continually cutting the budget while it's possible and while it's necessary, is also going to be difficult, especially in this high inflationary environment.
Senator Stedman?
A couple of general comments, Mr. Chairman. I think it's pretty hard to have a conclusion that inflation is going down. It's pretty much going up, and that's pretty indisputable. I don't think anybody knows if we're going to have 3.5% inflation or 2.5% inflation. But if you look back at historical inflation numbers at 2.5% over decades, and you can go back to the beginning of the last century, 3.5 seems like a reasonable number. I don't know if it's going to be higher. I don't know if it's going to be lower. Most likely, this upward pressure on inflation is going to be with us for some time. But what we can pretty much be assured that things regress to the mean, and even if we hold down the growth of our expenditures, it snaps back over time. And we can hold our operating costs down for several years, and then it pops back up. And we constantly see that when we start looking at decades in time when we run inflation against population. So it's hard to have the correct number. I think it's important for the committee just to see the kind of the magnitude of the effect. We could have higher inflation than 3.5%. Could be 3%, could be 2.5%, who knows? But we do need to give it some consideration that you know, it's highly likely we're going to be in an inflation cycle for some time, and it's just beginning. We already see it creeping into our budgets. We see it in our contract negotiations, and there is concern. You know, when we're putting this budget together this year, that we recognize that. So I think it's prudent, Mr. Chairman, that we, in this discussion, that hopefully we are looking out several decades for a stable formula, that we don't ignore the effects of this inflation over time.
Are you finished, Senator Stedman?
Yes.
Just to dovetail on that, Alaska's inflation was 4.9% for the last year. So, you know, as late as last week, the Federal Reserve was talking about 6 times for the year we were going to have adjustments to the
Rate hikes.
overnight rate hikes. Now, today, I heard that they're talking about 8 times. So over 4 days, they went from 6 days to 8 days. So obviously, it's a real thing as the Federal Reserve is having those conversations at the federal level. So just a data point, just another comment. Please continue.
Great, thanks, Mr. Chair. Moving on to looking at SB 199 with the trigger succeeding, so the PFD increasing to the 50/50 POMV draw and $700 million of new revenue also beginning in FY26. This is showing this probabilistic range of outcomes. Again, on the left side, that chart is showing the blue bars are the median return or the median surplus or deficit. So we're seeing, similar to what we saw 2 slides ago, modeling this, we're seeing small surpluses in the beginning years and about somewhere around 0 in the mid years to small deficits in the out years. And the range of outcomes, again, with the green bars is 50% are within that, are within somewhere in the early years from a couple $100 million in deficits to over $1 billion in surpluses. And that starts to drop in the later years as there's, based on our assumptions, there's, you know, almost a 25% likelihood of $1 billion deficits in FY31. And just to note that we've mentioned the committee before, specifically our oil production tax is nonlinear in that at the low oil prices, there's not a huge difference in oil price growing by $1 if the Alaska North Slope crude price goes up from $35 to $36. It's not a huge difference. It's a much bigger difference if oil goes from $98 to $99 based on our two-tiered structure of our production tax. And again, on the right, you're seeing at the median level, initial growth in the realized earnings reserve balance, and then it slowly declines back to around its initial starting level once we institute the inflation proofing. And under the 10th percentile level, you see the balance going to zero in about FY29. So 10% of the cases saw zero balances in FY29 of the ERA, which would mean that we would have no money to pay our percent of market value draw. And at the bottom, you can again see those CBR balance probabilities, and there's a moderate probability of the CBR balance being below $2.5 billion and less than a 10% chance for the first several years of the CBR balance falling below $500 million.
Please continue.
Moving on, we're showing SB 199 again, except now we're assuming the trigger fails, so no new revenue is instituted, and the PFD remains at $1,300, growing with inflation. And this is back using the standard Senate Finance baseline assumptions with the 2.5% annual growth in agency operations. You see pretty moderate surpluses of about $300 to $500 million throughout the period. No overdraws of the earnings reserve account or draws from the CBR, and a steadily increasing CBR balance. So this is basically showing a PFD that by the end of the period is about $1,500 per person and about $1 billion to pay for that draw of the FY31 $1,500 PFD, for instance.
Seeing no questions, please continue.
Showing the same scenario again, but with the 3.5% budget stress test, with the agency operations and capital budget growing at 3.5%. You're still seeing surpluses through the entire period, though significantly smaller than what we saw in the last slide. Since there are no deficits, there are no draws from the CBR, but the CBR balance in the reserve balance on the right chart, you can see is growing more slowly than the prior slide. And the PFD amounts are the same as the prior slide as well.
Please continue.
All right, last slide showing this SB 199 with the trigger failing. Now we're showing it with the revenue stress test. So the median surplus deficit, similar to what you saw before in the 2.5% Senate Finance baseline scenario, and a range of outcomes from about $400 million deficits in the early years to up to $1.5 billion surpluses in that basically 50% likelihood range. And CBR or ERA balances performing similarly. They're still basically, even in cases when there are no ERA overdraws, that we always follow the POMV draw and don't go beyond that. There is some chance still of basically the earnings reserve account going to zero, and that's just because if we don't see returns for enough years, we continue drawing to inflation-proof the principal of the fund and draw for government. There is some chance still that basically that balance is depleted.
Please continue.
Now moving on, this is a custom scenario that is assuming a 50% of POMV draw PFD in FY23, a $1,200 per person PFD in FY24, a $1,300 PFD per person in FY25, and then moving to a 50-50 percent of market value draw PFD in FY26 and beyond. Note that we are not assuming any new revenue in this scenario. So it is similar to the SB 199 with the trigger succeeding, except not showing that new revenue, and also having a higher 50/50 PFD in the FY23. And that's why you see in FY23, there's a $360 million deficit, and then a couple years of surpluses as we pay those smaller PFDs, which are $800 or $900 million versus the $1.7 or $2 billion for the 50/50 PFD. And then once we go to FY26, we start seeing those deficits of about 100 million or less in those later years as we pay that bigger PFD, but don't assume any new revenue.
Senator Stedman.
Thank you, Mr. Chairman. I was wondering if you could comment a little bit about the green bars on the right, the realized ERA, and how we could or should extrapolate that into the market value of the permanent fund itself, including the ERA in the aggregate.
Thanks. Through the chair, Senator Stedman, the green bars on the right are showing just the realized balance of the earnings reserve account. So that is the amount that we can freely appropriate. The legislature has the authority basically to, if they wanted to, appropriate that entire balance now. We have a statutory amount with the POMV draw where we can only draw we said in statute that we draw a certain amount. The legislature basically has the authority to appropriate beyond that. Note that this is different from the entire ERA balance. There is a additional unrealized portion of the earnings reserve, which is basically unrealized gains that are attributed to the realized balance. And while technically, legally, we can spend that money, mathematically, it's impossible to spend that money, since if the realized earnings reserve balance goes to zero, those unrealized gains associated with the ERA get reallocated to the principal mathematically. And also, I just realized that I forgot to note that this slide is based on using the governor's 10-year plan budget assumptions, which Director Painter outlined earlier on, which assumes that slower budget growth of 0% agency operations growth in FY24, and then growing at 1.4% per year overall after that, which is that 1% growth in Medicaid per year, and then the 1.5% for everything else.
Follow-up, Senator Stedman.
I must have really butchered that question. Let me try it again. For the last 40 years, past generations of Alaskans have ensured that we had a continual growth of the permanent fund from basically starting out at zero or very little. I can't remember what the first deposit was, 800 million or some number, up to 80 billion. And that wasn't by happenstance. And when we look forward, Mr. Chairman, at our responsibilities here for future generations of Alaskans, which hopefully we are, all of us, and we look at the multi-generational impact and effect, and also, frankly, right to some of the resource value being harvested from this generation into the future, the concern is what's happening in these scenarios to the aggregate value, the market value of the permanent fund that's hovering right now around 80 billion, with the effects of inflation impacted into it. And are we, or under what scenarios here, are we continually, on average, and I recognize markets go up and down like a yo-yo, are we on average increasing the intergenerational wealth for Alaskans? Or are we flattening this out so now we start being just on the consuming end? And that's the question, not the intricacies of the answer. And I recognize you're trying very hard to give me an accurate answer, but this is, are we leaving the potential for future generations one day to sit at this table with 120 billion sitting here instead of 80? Where at one time we sat here with 40 billion. Before that it was 20 billion. Before that it was 10 billion. We've been going in the correct direction for decades. So I think we need to be careful and cognizant of the decisions we make, that direction doesn't change. We can argue or discuss the magnitude, But clearly, the direction, in my opinion, should not change. We need intergenerational wealth increases for future Alaskans to benefit. And so that was the question on the green bar. Are we flattening out the growth of the permanent fund in aggregate, or is it increasing? If we put the market value of the permanent fund on these charts.
Through the chair, Senator Stedman, for the record, Alexi Painter again. So the green bar is just the earnings reserve. Going into the principal each year would be $1 billion or more of inflation proofing. I think over time that would increase a bit as the principal gets larger. And then also the royalty deposits each year, which is, I think in these years, somewhere in the $300 to $400 million range. So the principal would still be growing, even if the ERA is flattening out, because the entire growth of the ERA goes to the POMV draw and inflation proofing. In any of these scenarios with no overdraws of the POMV, the fund would continue to grow by $1 billion or more a year based on that inflation proofing and the new royalties going in. None of the scenarios that we were asked to do today in this presentation show ERA overdraws in that sort of deterministic scenario, so none of them would lead to shrinking the total value of the fund. In the probabilistic modeling, there are some scenarios because of investment returns where that would happen, but none of them at the median level. Let's see that.
Follow-up?
And I recognize that wasn't particularly asked for in the presentation and stuff, so I don't misconstrue, the point I'm trying to make is this: we need to keep an eye on that. Because it'd be nice to get the permanent fund to 120 billion. And it's as easy to get it from 40 to 80 and 20 to 40 and 10 to 20 as it is from 80 to 160. So just the magic of compounding.
Through the chair, Senator Stedman, one thing I'd comment is that with the 5% percent of market value draw and a 6.2% earnings assumption, even with 2% inflation, there's not really room for the fund to grow faster than inflation in that sort of median scenario. If you wanted the fund to grow faster than inflation, we would have to draw less than 5%, essentially, because of that, or we'd have to earn more than what Callan expects. The POMV draw was set basically to keep it level with inflation, so growth would require a lower draw.
Was some of us at this table that advocated for a lower draw amount and lost that fight too. Senator Stedman?
This is a follow-up. The fight's not over. There is concern that 5% is too high, and we've got multiple, I guess, challenges to solve here. The dividend formula, earlier was mentioned, the constitutional issue with the dividend, the growth of the permanent fund itself tied into the payout rate. So there's many facets to work on, but it is a concern that some of us have, that we allow the permanent fund to continue to grow, because it makes a huge effect over a couple of decades. And we can see it with $80 billion. If they would have capped it at 40 or capped it at 20, we'd have been having a whole different conversation here. Thank you, Mr. Chairman.
Next, if you're finished here, Connor, you ready to go to the next one?
Moving on to slide 21, this is showing that same scenario with the 50/50 PFD FY23, the $1,200 FY24, $1,300 per person FY25, then increasing to the 50/50 PFD in FY26 and after, and again, using the governor's 10-year plan budget assumptions, which assume significantly lower budget growth. This is showing the basically modeling variation in the revenues again, and the median amount is similar to what we saw before, and then you can just see the range of outcomes on the left and those green bars that, deficits, we could see deficits of several hundred million dollars, or surpluses of up to almost $1 billion in the later years. And at the median level, there's not a big difference in how the realized ERA performs, since at the median there aren't significant, there's overdraws from the permanent fund, and there again is some likelihood of the ERA balance going to zero. And for the CBR, there's about a 8 to 15% chance by the end of the period that the CBR goes below $500 million, which would lead to, based on our assumptions, we set the CBR at a minimum of $500 million for that short-term cash flow, and then assume that overdraws are made from the earnings reserve.
Please continue.
This slide is showing that same PFD assumption, except now substituting in the Senate Finance baseline budget assumptions instead of the governor's 10-year plan. So we're using that 2.5% per year agency operations and capital budget growth, starting with a capital budget of $250 million. And you see that $500 million deficit in FY23 as we pay the larger 50/50 PFD, which costs about $1.7 billion. $1.7 billion would be about $2,500 per person. And the deficits continue in FY26 when you revert back to that 50/50 PFD of about $600 million, somewhere in that range, as we again pay at that point in FY26 about a $2 billion amount towards PFDs or more. And you see in this scenario the CBR, the yellow bars on the chart on the right, going down to that $500 million balance and requiring ERA overdraws in FY29 through FY31, which are those red bars on the left side of the slides.
Please continue.
Now, we're again showing that same PFD assumption, but with the budget stress test showing the 3.5% annual agency operations and capital budget growth. Again, the $1.7 billion PFD draw in FY23 down to $800 or $900 million in FY24 and FY25, then jumping back up to that $2 billion PFD draw in FY26, which is about $3,000 per person. And again, we are assuming no new revenue in this case. So using the higher budget assumptions here, the ERA overdraws begin in FY28, slightly earlier, and you see deficits of up to $1 billion in the later years. In the ERA balance on the right, you see declining more rapidly compared to the alternative scenarios as we are overdrawing further.
Senator Stedman, did you have a question, sir?
When he's done with the slide.
You're ready, Mr. Bell?
Yes.
Senator Stedman?
Thank you, Mr. Chairman. Just on the last two slides, I notice in FY23, there's $509 million in a red number, brackets, that's negative. Could you restate what that is in this scenario, is what drives that to negative? And then I've got a follow-up.
Through the chair, Senator Stedman. So we are assuming that paying a 50/50 PFD would lead to a $500 million deficit. Most of that stems from the governor's budget uses the ARPA revenue replacement, that federal revenue replacement of, I believe, $375 million. And we assume that basically that money, under this scenario, that money is used towards additive projects, so it's not used towards existing liabilities or existing budget obligations. And we assume $50 million in supplementals, and that we have basically a few differences Director Painter has outlined in prior presentations of why basically our FY23 budget assumption is slightly different from what you see in the governor's 10-year plan.
Follow-up?
Just a quick clarification before I get to the point I want to make. The 50/50 PFD is for FY '23. How do you calculate, or does this take into account if we appropriate the catch-up dividend that the governor has proposed in his supplemental budget? Is that in or out of this scenario? And help me with that clarification so I can put a finer point on this negative 509, please.
Through the chair, Senator Stedman, this does not include a supplemental PFD for FY22. The governor's proposal does include a supplemental PFD to make up the difference between the actual PFD paid so far in FY22 and the calculation for the 50/50 POMV draw. I apologize, but I cannot remember that amount offhand.
Senator Hoffman?
Thank you, Mr. Chairman. If it does not, on the bottom of the page for FY '23, we have a dividend of not 1,100, but 2,542, and then it drops back down to the 1,200. So it would seem that we do have the governor's close to the 50/50 in this chart for FY '23.
Senator Stedman?
I think the question wasn't the 50/50 in '23 is there, but is the 50/50 in '22 there? That's the question, the current year, because it absorbs another 700 some million, I think, in cash. So, you're already starting with a negative 500. And the point I want to make, to get to the $1,100 dividend this year, we took out roughly $660 million in other savings in ARPA money to get there. And we've had discussions at this table to replenish that $660 million. So at least we have the same cash position that we had on June 30th, $660 million. So anyway, it's just a point I want to make, that if we were to do that, do the supplemental budget proposal, that extra dividend, this number is going to be over $1 billion
On the top line.
on the top line of 23. That's the point. I mean, we got to make, there's only so much money, and we don't have a printing press like they do in Washington, D.C. So there's just a concern that number could be significantly bigger. Thank you, Mr. Chairman.
Yep. Please continue, Mr. Bell.
Continuing on, this is again showing those, the same PFD assumption with the 50/50 PFD in FY23, back down to a $1,200 per person PFD in FY24, a $1,300 per person PFD in FY25, then jumping up to a 50/50 PFD in FY26 and after, and again, not adding any new revenues. And as Senator Stedman spoke to, this does not assume any supplemental PFD is paid in FY22. You see basically within the 50% likelihood of our scenarios, you can see beginning in FY26, deficits of over $1 billion are also a couple hundred to several $100 million in surpluses, since there's basically a lot of it is due to uncertainty in oil prices. There's a huge change in our budget depending on where oil prices fall, and so it leads to a pretty large range of uncertainty. Since you're seeing more deficits, we are seeing a higher likelihood of the CBR balance going to below $500 million and requiring a overdraw of the permanent fund.
We don't want to do that, for sure. Senator Stedman?
Just as a reminder, I think the $500 million minimum balance in the CBR is just for us to make payroll. and general cash flow. That's the magnitude of the state organization in the entirety. We need 500 million to make sure people can cash their check. If they want to buy groceries and a mortgage payment, take care of their family. So going below 500 is off the table. We would have to resort to other means to deal with it if that event ever was upon us. Thank you, Mr. Chairman.
Yep. Mr. Bell?
That was our last slide. Note that we have some appendix slides showing the same modeling assumptions for a statutory PFD and a 50% of the POMV draw PFD for all years. And so those are there for your reference, but we're happy to answer any questions.
Senator Stedman?
We have a few minutes left, Mr. Chairman, and the public's watching. It'd be nice to, put these slides up and talk about them a little bit.
Mr. Bell? You want to keep rolling with the slide deck?
Great. Thank you. I'll proceed on then to go through the the other PFD options. This is slide 26 is showing the current statute PFD, which is the 21% of the 5-year statutory net income, and half of that amount. And this is a much larger PFD under our current circumstances than even the 50/50 POMV PFD. So in FY23, it's about $4,200 per person. And under the scenario, you see significantly greater deficits of about $1.5 billion in the first several years. The FY23, there's a small ERA overdraw. The existing CBR balance fills most of that first year's deficit, but we do have to resort to a small overdraw in that first year, and then the overdraws from the ERA continue. So, that basically those red bars, they could be filled with new revenue or budget cuts. We don't incorporate any of those basically policy changes into our modeling. So we are just showing it here as ERA overdraws. And on the right, you can see the realized balance of the earnings reserve, that portion of the permanent fund we can spend. You can see it rapidly declining to go below $6 billion by the end of the period.
Please continue.
Now we're again showing that statutory PFD, the current statute, permanent fund, dividend, with now higher budget growth, 3.5%, agency operations and capital budget growth. So with the higher budget, we're seeing the surpluses grow, the deficits grow over time to about $1.8 or $1.9 billion by the end of the period. The ERA balance falls to around $4 billion by the end of the period. And that does start to have some impact over time on the statutory PFD is impacted by the smaller total fund balance, in that it does take time to catch up to that amount since it is a 5-year average, but you will see that the PFD amounts decrease over time.
Please continue.
Right, moving on to showing this statutory PFD with our revenue stress test, which is again running a bunch of scenarios with different oil price and oil production and market return assumptions. The median with the blue bars are similar, and then in that 50% likelihood range of outcomes, we can see basically $2 to $2.5 billion deficits, and at the high end, we still expect deficits, but smaller in the basically several $100 million range for the first several years, decreasing over time. And at the 75th percentile level, we see, so basically in 25% of cases, the ERA balance increased, and in, the other 75% of cases, we saw that the balance of the ERA decreasing over time. And then there's about there's a less than a 10% chance for most of the period that the CBR balance is sufficient to hit the 2.5 billion, which would be the amount suggested by the co-chairs for using the CBR as an actual budget reserve, and about a 78% chance in the first several years of the CBR being below that $500 million balance, which is the minimum amount for that short-term cash flow.
Senator Stedman and Senator Wilson.
Thank you, Mr. Chairman. I hate to be the bearer of bad news, as I do have constituents that do appreciate and would like to have the statutory dividend of $4,200 or $2.7 billion in a payout. Problem is, we'd have to, according to these two slides, and you just average them, take the middle amount at FY 31, you're roughly 1.5 to 1.6, so just round numbers, $1.5 billion we'd have to raise in revenue. We're not going to cut the operating budget, because our operating budget that's on the table is an increase, not a decrease. We have increases in employee count, a few hundred, we're still putting a number on that, and other needy areas, corrections, public safety. A lot of the other items are remaining flat. So we're not going to take a $1.5 billion out of a 2.5 or a $4.5 billion budget. That's just fantasy land, beyond fantasy land. It's hallucinations with LSD. This isn't a fun discussion or a fun subject to work on, but that's what we're elected to do. We can't do the statutory formula. And these two slides, hopefully some of the public take a look at it, show you why. And even if they're off quite a bit, they'd have to be off a mile to make up 1.5 billion. So anyway, with that being said, that leads us to the conversation of being forced to change the statutory formula. Nobody volunteered to do it, I could assure you. But we're dealing with what we're elected to deal with. So that's why I think it was important, Mr. Chairman, that we continued on and we had these, presented, because just so that we can see the magnitude of why we're here. Thank you, Mr. Chairman.
Please continue. Oh, Senator Wilson has I'm sorry, Senator Wilson.
Thank you, Mr. Chair. Mr. Bell, earlier, I forgot to ask this question and these assumptions on the CBR balance. What is the CBR balance that we start the assumptions on? And I didn't know if you included the sort of where that $400 million court case situation, does that in the CBR, out of the CBR for the higher ed fund?
Senator Wilson, through the chair. So the $400 million from the higher ed fund and other sweepable funds, we're assuming is in the CBR, even before the court case. It's currently there, so we included that. So the starting CBR balance is something about $1.2 billion, including that. So it's below that $2.5 billion threshold, which is why in pretty much every scenario, we start out below in that first year. However, with in FY22, if there's a surplus that's not spent, you could get that CBR balance higher than the $1.2 billion starting, just by not having that back pay dividend that the governor has proposed. So most of these scenarios, you get an increase in that first year in FY22 to carry into FY23.
Thank you.
Please continue, Mr. Bell.
Great. Continuing on to slide 29, this is showing a 50% of POMV draw, PFD, which is again 50% of our current structured draw of 5% of the 5-year average of the permanent fund market value. This is the Senate Finance baseline with the agency operations and capital budget growing at 2.5% per year. The 50/50 dividend is significantly smaller than the statutory dividend previously shown. It's about $2,500 per person in FY '23 and would grow to be over $3,000 in the later years per person. The deficits in the early years are about $500 to $700 million per year. And the under these assumptions, the CBR gets to that minimum $500 million balance in FY '25, which is when you start seeing those red bars indicating overdraws of the earnings reserve account beyond, so drawing from the earnings reserve beyond that structured POMV draw.
Please continue.
Okay, we're now showing the 50/50 PFD again with the budget stress test, with the agency operations and capital budget growing at 3.5% per year instead of 2.5% per year. The first year, it looks the same, and as that budget grows at a faster rate, you see the gap in the deficits grow more steadily, up to $1.1 or $1.2 billion in the later years, and a more rapidly depleting earnings reserve account, which you can see on the chart on the right.
Okay. Last slide.
And I believe this is the last slide. This is showing the PFD at 50% of the POMV draw again, with the varying revenue assumptions. And so on the left chart, those green bars showing the basically 50% range of certainty under our assumptions would be somewhere between, 1.2 billion in deficits to about, a few to several $100 million in surpluses within that 50% range of certainty. And that basically falls over time, and you see less likelihood of running a surplus in the later years under these assumptions.
Senator Von Imhoff?
So, thank you. So we did see, in the beginning at least, two different scenarios. I'm not counting the statutory PFD towards the end, but two different scenarios. One modeled paying about $800 to $900 million a year for a dividend, the 75-25. And then the other modeled paying over $3 billion a year at a dividend for the 50-50. And this modeling, just to remind you, it was assuming about $71 a barrel. Is that correct?
Through the chair, Senator Von Imhoff, we're using is the basically the middle level. It is the $71 per barrel in FY '23, and then DOR is following the futures curve at the time of the release of the forecast, which actually drops slightly into the high 60s, and then rising up by the end of the period into, I think, $69 or $70 by the end of the period again.
Okay, so that's good, because I have, Mr. Chairman, thank you. So I have the last 5 years. Oil is about in the mid-60s or so. It seems to be more the traditional price, and of course stabilizing going forward. That's what the futures market is sort of saying. Of course, right now we're at 90 or above, and I know that I've heard a few folks on the radio in recent days saying that we are rolling in the dough. We're being showered by cash, and just like you don't build a church for attendance on Christmas and Easter, you don't pass a dividend bill based on $90 in oil. We need to find something that's sustainable and affordable over time. Thank you.
Thank you. Seeing any further comments from committee members? Thank you for a great presentation. Our next meeting is this afternoon, February 21st, 2022 at 1 p.m. We will be taking public testimony on SB 199 and SB 200. And seeing no further action items, we are adjourned.